trying to strike that balance with various different entities, and you say we cannot totally decouple. At the same time, if we were to totally decouple, we'd lose a lot of the potential economic leverage that we could have long-term to perhaps be valuable in deterrence. So there are other reasons why it's not such a bad thing for our economies to be intertwined. When you think about making these restrictions, do you think that they should be company-specific or sector-specific? How would you approach this? Maybe start with you, Jay.
Well, look, it's a terrific question. Let me give you a micro example and a macro example around your transparency question, which is at the micro level, do we really know that the information we're getting is correct? Okay, if we do, people will make good decisions. If you look at U.S. companies that are disclosing their level of integration in China, investors are telling them that's too much. I need you to de-risk. If you want more of my capital, you should de-risk your supply chain. But if what we're getting from Chinese companies or other companies around the globe is not candor as to those types of issues, it's difficult for investors to make those choices. That's where you go to the macro issue. If the government, our government, sees that across companies, I think it's incumbent upon the government to say, we're looking across these companies, and we don't think that information adds up. We think that you should discount the value of some of that information. That was the motivation behind the Holding Foreign Companies Accountable Act, and I think it's something that our regulators should be looking at. So, and then to your specific question, where do you draw the line? I think it's a mix, right? I think there are certain industries, if you look at the EO, where it's pretty easy to go industry specific if that's the choice you make. And then there are other more nuanced questions for companies that may be multifaceted or the like.
Ms. Stephenson, I'd love to hear your perspective on this, and also then talk about how we think about VIEs. Should we just completely restrict VIEs and wipe them off the face of the planet, say that is not a legitimate investment vehicle? Or if we do that, will they just find another way around it? And so we've got to be more thoughtful about what the second and third order consequences might be.
Well, as to the first question, I would say first we need to strengthen the regulators. So I think that for example, the PCAOB needs to stop giving China a pass on. They've already made tremendous progress in being able to audit in Hong Kong this year, or last year, I guess. But it needs to go a little farther. The audit failure rate was extremely high. The IMF has given China a pass on giving detail around its foreign, foreign reserves for a long time. So those things need to stop. We need to apply the same regulations to China that are applied to every other country. After that, I think we look at the export restrictions and we follow those. We have a very competent team at BIS, so we follow them and look at what they're doing. I think the import restrictions and tariffs tend to be less effective. The export restrictions tend to be more effective. So we look at what technologies those are focusing on and perhaps focus on investment in those.
And if you could, for the record, just take this question more specifically to VIEs.
Oh, VIEs, I forgot. Yeah.
We'll probably have time for a second round if we
okay.
Go back to it.
Mr. Chairman, I yield back. Thank you.
Thank you. Ms. Hinson.
Thank you, Mr. Chairman, and thank you to both of you for joining us today. It is absolutely critical we continue to shine this light on what the CCP is doing to continue to undermine and aggressively and systematically undermine our economic success here in the United States, using our U.S. investments, as we've already discussed, to fund companies that aid the PLA and assist in those egregious human rights abuses that I think we all need to be more cognizant of as consumers as well. I think our small businesses also, working families should be able to trust that their investments are not being funneled to these malign practices in China. And while they continue, the PRC and CCP continue to kind of worm their way into a lot of international trade agreements, they're not following the rules. They're simultaneously sidelining deals and promises that they've made. That really undermines, obviously, our agricultural and manufacturing success and stability here in the United States. Whether it's digging in a cornfield in the state of Iowa to try to get those seeds out and reverse engineer them and steal that IP. They're trying to harvest Americans' information, personal and financial data. They're undermining our tech sector's ability to innovate. It could not be clearer to me how blatant the attack, really, the PRC has unleashed on our country to try to destroy our financial security here in the United States and undermine our critical industries. So I have a couple questions. I'm going to direct them to both of you, so feel free to give your perspective. But what would you say is the most concerning avenue that you've seen the Chinese use to really exploit our U.S. capital markets and companies?
Please go ahead.
I will go back to the things that I say are fundamental. Transparency and accountability. Mm-hmm. To the extent that you flout transparency and accountability, that undermines our capital markets and allows you not to make good investment choices. And stability, global financial stability. It's essential to investment flows and trade. To the extent that the Chinese Communist Party would take actions that would jeopardize global financial stability, that is something of great concern.
But do you think, obviously it's a signal when they stop reporting information because it's so bad, correct? I mean, that's a signal to investors, hey, you probably need to pull back here because we're not getting that transparent and reliable data from the Chinese.
Look, information is the lifeblood of markets. Transparent information is the lifeblood of markets. And I think that you are seeing, I would say, the investment community writ large respond to a view that the information they're getting is not as reliable as it maybe has been in the past, or not as reliable as it was expected to be. So that's for sure.
Ms. Stevenson-Yang?
Yeah, I would agree with all of those comments. I mean, in China, the idea of a U.S. IPO has been you struck gold. You won your lottery ticket. You managed to collect a whole lot of money. And whatever means you use to get to market have been sanctioned within China, and there's no regulator within China who watches out for that sort of activity. So what we need is clearer analysis and more critical analysis of companies that are trying to IPO in the United States, and stronger standards about forcing them to delist if they have misrepresented their data.
Turning that around a little bit on the companies that are trying to do business in China, obviously they're trying to work within the regulatory framework, but we've seen some of these kind of frequent offenders in China kind of pushing the envelope with American companies trying to do business there. What do you think we can be doing to support these companies and industries as they continue to make those investments but face those uphill challenges from the PRC?
I'm not sure that there's a ton that we can do except through the WTO. There are a number of WTO agreements that China has not abided by over these 20 years. So I think maybe we go to that forum and push a little bit harder. But in the end, China has this magic wand, which is the approval rights over companies. So even though they've agreed to allow U.S. foreign participation in banking and telecom, for example, if they don't approve the companies, then you can't participate.
Right. Well, it's certainly a red flag for American investors when their capital and their risk that they're taking could be immediately upended by the whims of the Chinese Communist Party. Thank you. I yield back.
Ms. Stevens, recognized for 5 minutes.
Thank you. I'm interested in indirect capital flows hailing from the industrial Midwest, where we see major components of our automotive supply chain invested in China. This certainly began at the beginning of this century in an accelerated way, where we were chasing low labor costs and exposure to markets. COVID woke us up to incredible supply chain vulnerabilities. But if you are a tier 1, tier 2, tier 3 supplier looking to expand and grow your business, and you look up expanding my business to China, and you get a sense of the opportunity and risk, there is very little articulation about the capital risk. And so when we look at dollar flows, and certainly here in the United States, we're very well aware of the capital crunches. Venture capitalists are sitting on enormous sums of money. Capital investments are down 70% from 22 to 2021. And I am concerned about what this means for our supply chain. Particularly, is this going to motivate further pushes outside of the United States? What are the continued risks? Our ranking member just presented a very great case about our pension funds and our thrift savings plan. But what does this mean for the everyday manufacturer? What does this mean for our suppliers? And what steps should our manufacturers take when assessing expanding into markets today like China?
That's a great but very complex question, and I would say that sort of offshoring really began in the 1980s, and in a way became such a behemoth that the U.S. government could no longer control the companies that were investing overseas. And the Midwest industrial heartland is not so much investing in China for the Chinese market as offshoring and outsourcing. And that clearly, I would say the biggest risk there is the currency, because as these companies make more money and want to bring it back to the United States, they run into currency controls and they may not be able to get dollars out. I think that what you're seeing now with companies is what they need to do, which is spread risk. So push some of their contracts to Vietnam or to Malaysia or to other countries so that they have other places to go. But if China really does close up, will it be a big shock to the U.S. supply chain? Absolutely.
Well, and Mr. Clayton, you talked about in your testimony getting an understanding of these risks for public and large companies, particularly from the investment side. And you've had a great career, and it's a treat to have both of you here today. But as best as you're able to, could you talk about export controls and exposed risk, particularly with what Ms. Stevenson-Yang just mentioned? If China closes off, do we have any protection for our small manufacturers who are maybe over-leveraged or over-invested? We've obviously run these different scenarios in this committee on the economic ramifications, but I know from firsthand experience there's way too many small companies that have had to expand over to China. They have a presence there. They were hurt by COVID, absolutely, but now we're looking at this new environment. Do we have the protections in place for these companies?
You make a terrific point. We talked about abrupt dislocations in markets and the ramifications, whether it's pulling back on investment, pulling back on consumption, and the kinds of stresses that puts on companies. That does not happen uniformly. Anytime you have that kind of dislocation and stress, it is typically the smaller and medium-sized companies that suffer most because they're unable to access capital, they're unable to pivot to the same extent that large companies can. And it is a consideration when you think about decoupling and the like. The other point I'll make that you also raised, and you both raised this is multilateral. If there's a de-risking, decoupling with China, it doesn't mean every activity comes back to the United States. We see Mexico right now having the greatest inbound investment that we've seen in a long time. I think that's largely related to the de-risking of the supply chain, as you mentioned. So I want to make sure.
Yield back.
I will now entertain a second round of questions. I'll recognize myself for 5 minutes. First, a comment. I think when I sort of began this journey on the committee, particularly on the financial and economic aspect of competition, I just assumed that a lot of the pushback we got from Wall Street was because of the returns that were to be made in China, right? Put differently, the reason people continued to pour capital into China, even during the pandemic, was basically the same reason John Dillinger robbed banks, because that's where the money is, right? But in digging into this, and particularly if you read Mr. Chanos' testimony, it's not clear to me that this is even a good investment at this point. And I quote Chanos here in saying it's no surprise that Chinese stocks have significantly underperformed relative to U.S. stocks. Since 2010, the S&P 500 total return index has outperformed a China stock ETF by a factor of 8x on a relative basis. On an absolute basis, the China ETF has nearly been cut in half versus the S&P 500 total return, increasing over 5x. So even if you put aside the moral concerns that I think the ranking member brilliantly laid out, or the geopolitical concerns, just as like an investment proposition, the risks are mounting up, or the returns aren't there. You can comment on that when I ask a question. The other thing I have to bring up that I've been struck by on this trip, and we've had great discussions and a great tabletop, and this has been very illuminating, but almost everyone we met with a few exceptions, has asked that we keep their identities secret. If you think about it, these are the same people that have no problem going to Hong Kong and Beijing and, you know, dancing with Leo Hud, various conferences. And yet when they meet with members of Congress, it's like we're in some witness protection program and we have to shuttle them around, which I kind of think gets to the, maybe it's related to the Wolf Warrior point, or just we're so sensitive to the reaction. In fact, we had people tell us explicitly that their Chinese LPs would object if they knew they were meeting with us. That kind of crystallizes, I think, the dilemma we face and how difficult it is to mobilize action in light of those concerns. Mr. Clayton, to get a better handle on this problem, you talk about this in your written testimony, but I want you to say it orally. Should Congress mandate that publicly traded companies disclose their exposure to the PRC?
Okay, let me say that I am generally not in favor of issue-specific mandatory disclosure for public companies. I think we often use the securities laws to accomplish other objectives. In this area, I believe that large public companies that have significant exposure to China, for the reasons you just articulated, I would say a greater understanding of the geopolitical risks, the company risks that we've come to learn from COVID. This is an area where I would at least consider a pilot program for very large companies disclosing the China-specific risks and what type of scenario planning they have done in the event of abrupt decoupling. And look, this is not about liability. It's not about gotcha. It's just about, in the boardroom, if you have a substantial exposure to China, how have you thought about the type of risks that you're talking about if they come to fruition, and provide that information to investors? I think those questions are already being asked. Yeah. But I think that this is an area where you can show leadership. And I would say, you know, look, again, I'm not a big fan of excess liability. I think we have too much of it. But you can show leadership in the type of disclosure, the type of dialogue that companies should be having. I'll just make one last point there. During COVID, this is exactly what we did. We asked public companies to come forward and say, given all the challenges of a lockdown, given all the challenges that, give us your best estimate. Give us your planning as to what you're going to do in response. U.S. public companies did a fabulous job. They told the public, here are our challenges, here are human capital challenges, here are our supply chain challenges, here's what we're going to do about it. And it instilled great confidence in the marketplace.
So what exactly, in your paradigm, would they disclose in a pilot program? Would it be revenue generated in China? Would it be, you mentioned the contingency plans they have?
Yeah, my view is if they have a certain level of exposure to China, that they should say, here are our contingency plans in the event that we were to have an abrupt decoupling. This is what we've thought about. And these are the risks. I think investors know they exist, but that dialogue is a good dialogue to have.
Yeah. And then Ms. Stevenson-Yang is unfair in the remaining 23 seconds I have. To go back to the VIE issue, just in simplest terms, what does one own when one owns the VIE? And what shareholder protections does one have?
One owns a stream of revenue, not profit, because profit is explicitly not permitted under Chinese law. And what protections does one have? Companies arrange that the owners of the VIE sign documents that allow them to, that allow investors to kick them out if need be. But it's a fairly thin reed to hang on.
Yeah, thank you. My time has expired. Mr. Krishnamurthy.
Thank you again. We all know that the CCP bans books, but now it's also cooking the books. Take real estate. According to government figures, new home prices have slipped just 2.4%. That's according to the CCP. But data from private sources tell a different story. Existing home prices have fell by at least 15% in areas like Shanghai and Shenzhen, and the city of Guangzhou saw a price drop of about 25%. Ms. Stevenson-Yang, one very humorous part of your past statements include the following. You said, quote, "When you go around and meet state-owned industry people, everybody laughs at the national statistics. So I don't know why foreigners believe them." Ms. Stevenson-Yang, when it comes to official PRC government statistics, you noted in your testimony that numbers are often distorted in order to reach goals. They're goal-driven. That combination of factors right now, a serious real estate crisis involving vast amounts of debt, and a government that misleads the world about basic economic facts, poses a serious threat to the global economy. Isn't that what you think?
I think that's correct, yes.